Welcome to episode 35 of the Cashflow Connections podcast. The topic for today is multifamily going crazy again? Today, we're going to hear a cautionary perspective on the state of commercial real estate, particularly in the multifamily sector. Our guest is wicked smart, extremely knowledgeable, and really cautious about buying in today's market. In fact, he says that his real estate firm basically isn't buying real estate right now. So we're going to talk a lot about the lending market. We have an interesting discussion about why debt is so critical at this stage of the cycle. What are the terms borrowers able to acquire right now? What are the debt service ratios? What are the loan to values? And where would these numbers be if things were more normalized? Also, when you're underwriting deals right now, should you be more focused on the downside protection rather than the upside potential? Our guest certainly thinks so. Actually, he says that his firm completely stopped underwriting upside for any prospective investment, which is pretty considerable given their track record in the business. So I guarantee you're going to hear a perspective that isn't frequently discussed in the real estate podcast sector, but is important to be cautious right now for a variety of reasons. Now, before we get into the episode, our guest utilizes a lot of commercial real estate abbreviations during the conversation, so if you aren't already familiar with the language, it may get a little bit confusing. So just a quick summary before we jump in. So the main terms that come up frequently are DSCR, IO, and LTV. So DSCR is an abbreviation for debt service coverage ratio. This is the net operating income divided by the debt service, meaning the total amount of money going towards paying off the debt of the property. It's expressed as a ratio. So for example, if you had $140,000 of net income and the debt service was $100,000, you would have a DSCR of 1.4. Now, the lower the DSCR, the closer you are to not being able to pay off the monthly mortgage. And of course, if you go below 1.0, you don't have the ability to pay off the loan. Now, IO is an abbreviation for interest only. This is the portion of the loan, typically in the beginning of the loan, where there's no payment going towards paying down the loan. Sponsors usually utilize this in an effort to supercharge cash flow in the beginning stages of the loan because this is the point at which they haven't really implemented the value add strategy yet. So typical interest only portion, that's usually 1 to 3 years, and we have a conversation about where that is and where that should be appropriately used. Also, LTV is just loan to value. This is essentially how big the loan size is compared to the appraisal of the property. In commercial real estate, loan to values typically range from 65% to 80%. And of course, the higher the LTV, the more aggressive, the more leveraged the opportunity is. So I know a lot of you already know this, but when you hear the interview, I think you'll understand why I wanted to take a second to kind of go through that. And it's a really interesting conversation, definitely a detailed conversation, and it's a unique perspective. So I hope you enjoy the episode. How's it going, everyone? Our guest for today is Jack Ehrman, who is the co-founder and CIO of Post Investment Group. Jack has dedicated his career to the identification and execution of sophisticated real estate strategies across the board. He oversees the financial and tactical aspects of Post, including all transactional functions of the business. In this capacity, he principally manages the acquisition, disposition, and financing of Post real estate, as well as the strategic macro-operational aspects of Post Holdings. Post currently holds almost 12,000 apartment units located throughout the United States. In fact, we also had Post's other co-founder, Jason Post, on the podcast not too long ago. You can look up Investing Late in the Economic Cycle. It's a great episode. So again, I'm really looking forward to this one. Thanks again.
Oh, my pleasure, Hunter. I appreciate it.
So Jack, before we really jump into the details, which is going to be about your perspective on the market, where we are in terms of multifamily, let's talk a little bit about what you're doing over at Post and how you see your strengths and duties really complementing Jason's.
He and I try to bifurcate duties at the company, based on our primary skill sets, mine being financial and strategic, his being more macro and networking, as well as a very strong understanding of underlying real estate in general, which we both have. Over the past 10 years, we've built a pretty strong working relationship that for all intents and purposes is an all hands on deck. We both kind of do a little bit of everything. At the company, I tend to build a little bit more of the procedural based analytics, exactly what type of assets we want to dive into given any given inflection point in the market. But for all intents and purposes, realistically, we kind of just manage it together. As
Totally.
far as, yeah, so I'm sorry, go ahead.
No, yeah, and I mean, historically speaking, what type of transactions do you guys typically involve in? I think that you're involved in a variety of different risk profiles, but what's kind of your bread and butter and historically speaking, your focus?
So the company's built to be primarily a multifamily real estate investment vehicle. We run the gamut within that sector. What we're doing is always cycle dependent. We've built a great reputation, had great success in front running the market, basically building individualized investment theses to exploit current inefficiencies in the market, and for all intents and purposes, deploy capital structures that allow us to capitalize on that, as well as protect equity in the event the market doesn't go the way we think it will. To date, 11 years later, we still haven't lost a single investor dollar. Certainly, that's not sustainable, but we're very proud of that.
Definitely. And so you've actually been involved in development, value add, stabilized, and affordable. So really across the board. Where are you currently seeing the opportunity right now as it presents itself, particularly in the multifamily sector?
That's an interesting question. Right now, considering we are relatively risk averse in this cycle, we're not seeing a lot of opportunity anywhere. As you had mentioned, we run the gambit of acquisition within the multifamily sphere, all the way from extreme distress all the way up to trophy AAA class development. And right now in the market, we don't really see any value anywhere. Um, it's a sad state. I understand that, a real estate investment company saying we're really not investing in real estate at the moment, but we're in capital preservation mode, focusing on our portfolio, trying not to sell everything. And trust me, that's a struggle every day, seeing the valuations in the market right now.
Totally. So let's talk a little bit about that then, because I think it's an important part of the conversation. What are you currently seeing in terms of where are we on the cycle? And I guess more importantly, what metrics are you using to kind of determine that it's really challenging to buy properties and anticipate them being worth more later down the road?
Yes, it truly is. Where I see ourselves in the cycle is a little unique in what we've seen in past cycles, in that I would say we're about one step down from an extended plateau. Typically, you would say a peak, but that peak, for all intents and purposes, has turned itself into a plateau because of historically historic non-volatility in the broader markets in general, but more importantly, the capital markets. I don't think we've ever seen an extended run like this of long-term, stable, low interest rates and non-volatility in the market. So, we've seen QE from the US, we've seen QE from Europe, we've seen all countries trying to moderate their currencies so as not to have any true economic imbalances, and that has just created this. I think we're now in year 6 of extended low interest rates and easy money borrowing that has seen valuations, for all intents and purposes, plateau from 2000, late 2014 up until probably 8 months ago, when we've seen a small pullback, but we're still right at the top there. I don't think it's sustainable, but I would have told you I didn't think it was sustainable back in 2015.
And were you guys making purchases back then as well, or were you as cautious as you were in 2015? And if I said, where's the opportunity right now, would you have given me a similar answer back then?
I would have. Actually, I would have given you and no one likes to admit this because everyone likes to think they're the smartest person in the room. But back in 2014, we were even more risk averse. We were convinced that the market had nowhere to go but down. This is before we saw any impacts of Brexit. This is before we saw any real impacts of Euro QE. No one could have anticipated those things happen. If they could, I want to shake their hand and I want to be their friend.
Right.
Hire them if they'll come in. As back in 2015, we, as post-investment, had a lot more fear than we did now, just because we didn't see any mechanisms for having the capital markets extending into 2018, like we did today. As we see a little bit more stability outside of, we'll call it, the past 2 months. We'll put a pin in that. We can have a conversation about that later. But in 2015, there was a lot more fear on our side in the markets. Coming into 2016, 2017, we saw everything start to normalize a little bit. The agencies had stopped screwing with their loan packages. We saw some opportunity in just playing long-term debt arb, which is basically what we've been doing since 2013, which is just taking long-term, lower leverage debt, putting it on very strong collateral and very strong markets, and extracting a dividend into perpetuity. It is not sexy, but it's a way to build wealth slowly in the multifamily sector at this inflection point in the market.
Okay, and just to clarify for the listeners then, so you're talking about you have prime assets that are performing, that are fairly stabilized, if not 100% stabilized in terms of the operational efficiencies, and your main strategy then was just to basically acquire really attractive financing given the low interest rate situation. Is that what I heard there? Is that, or were you actually on the lending side of a transaction with other operators?
So we were on both, but when we're talking just on the equity side, the traditional multifamily investment side, you are correct. Yeah, it was finding very strong assets in very strong markets, building a capital structure that, one, allows us to extract exceptional yield in the best of times, but most importantly, is built to be sustainable during a substantial market softening. Mid 2014 on, we flipped our switch and we stopped underwriting upside. We started only underwriting downside. So if we could see adequate downside protections in these strong assets, we'd buy them. If we couldn't, we would sit on the sidelines and be happy operating our current portfolio, waiting for the next great buying opportunity.
Yeah, that's really interesting. And again, I appreciate you sharing the transparency in terms of, what has happened since 2013, 14, et cetera. I think a big part of this conversation is, of course, debt and access to debt. Are you, first of all, before we jump into that, let's talk about why debt is so important. Give us some of your thoughts on why the debt financing terms are so important. That was the first thing you mentioned when you mentioned your most recent real focus. So why is that before we jump into the details?
Absolutely. So pulling it all back, breaking it down to the most fundamental, the most fundamental is real estate. Real estate changed in the mid 1990s. As CMBS became a larger force in the markets, real estate transitioned from being commodity-based to a true financial derivative product. As opposed to being priced on per pound metrics, it started being priced on yield metrics. And yield metrics, that the primary determinant of that was your cost of capital, your debt. As debt became more prevalent in the market, pricing fundamentally changed, and one of the biggest aspects of evaluating a real estate asset became what kind of debt financing you could put on it. So moving forward through 2006, through 1996, we saw real estate values move up substantially as equity and debt became a larger part of the cap stack, and more importantly, as debt became the predominant part of the cap stack, moving all the way up to 105% LTVs you can't see my air quotes, the best of times in 2005.
Right. Yeah, that's a really good point. So this is something that, we've spoken earlier about similar topics. And I think that one of the things you make really clear, to put it another way, what you just said, imagine if all of a sudden, all of your investors out there wanted a 3% less annual return. Think about what kind of impact that would have on real estate assets. Now, times that by 3 or 4, and that's the type of situation that takes place when you talk about debt, because usually the debt portion is 3 or 4 times as high as the equity portion, depending on the type of transaction you're looking at. So just something to keep in mind. This is why debt is so important, particularly late in the cycle, because it's imagine the bulk of your investors just completely changed their entire risk profile. I mean, it's even more important than that. So let's talk about, I guess, some of the standard metrics that you look at and what you're seeing right now in the marketplace. So typically, LTV, IO period, debt service coverage ratio. What are some of the metrics you're seeing, and which ones are standing out that are kind of pointing you to that peak or late extended plateau, as you said?
Yeah, absolutely. And before we get to that, I want to go back to the analogy you just used, which I thought was great, a very succinct overview of exactly what the impact of debt has. And the other important aspect you want to add on there is the cost of that capital, whereas debt is, the 3 to 4x of the cap stack. And an equity investor, their cost of capital may be between 8 and 15%, depending on what their risk profile is. The cost of capital of debt financing, in 2005 was 6.5% on the interest rate, is all IO. So that was the loan cost as well. Moving down to today, where that cost of capital is, or two months ago, that cost of capital was 3.5%. So you can see the fundamental value driver there simply as a function of your cost of capital is substantially cheaper. So you can pay more because you can extract the same yield with the same debt.
Exactly. Good point.
So moving on. So what are we seeing in the debt markets? What do we predominantly look at is, as I'd mentioned earlier, is we've been in this historic plateau where there's been no volatility or relatively little volatility in the capital markets. It might be beneficial to give a little bit of history of what's happened since the downturn. Obviously, moving up to the downturn, it was all about the bells and whistles in the financing. CMBS had moved LTVs up easily into the 90s for any kind of collateral. Realistically, metric agnostic. They didn't really care what any of their yields or standard hurdles would be. The downturn hit, and lenders became more cautious. Started putting 75%, 70% limits on LTVs, and wanted DSCR, debt service coverage ratios, in the 1.3 range. As this plateau continued to go, and there started to be even more appetite from end user investors for this type of MBS debt, we saw the bells and whistles coming back. Interest only moving back into the market. In fact, interest only is now as prevalent as it was back in 2005. Again, you can easily get full term IO on a deal with 65% leverage. That used to be full term IO on a deal that was 105% leverage. So you can see the differential there in 2005 and why we got into that problem. But they're coming back with this stuff now. Agencies are back to just over 80% LTVs if you have cost buildup for value add additions. The DSCRs are back down to 120, even all the way down to 115 for affordable or deals that fall under the uncapped agency lending platform. So you've seen that real estate has a very short memory. We're starting to see a lot of what we saw in the last cycle. I think back more to your point is when we evaluate a deal, what do we predominantly look at? Obviously, the two easy ones are LTV and DSCR. LTV is more of a smell test for us, just to see what the maximum amount of debt we use. I think the last time we used the maximum amount of debt was 4 years ago. And the primary one we use is DSCR. As I mentioned earlier, we underwrite downside, and DSCR is the easiest one to look at as you try to evaluate what your risk could be with your lender.
Okay, yeah, that's awesome. And just to obviously, like, we went through a ton of content there, which is super useful. And so for some of the listeners that maybe aren't as experienced, just real quick. So LTV is the loan to value. This is usually established by the appraisal during the purchase. The interest only period is the portion of the debt in which the payer or the borrower is only paying the interest and that they're not actually amortizing the loan. And the debt service coverage ratio, or the DSCR, is the ratio between the NOI and the payments for the mortgage. So those are kind of the levers that banks and borrowers have to use to make a loan more conservative and more aggressive. The higher the loan to value, the more aggressive. The longer the interest only portion, the more aggressive, because you're not padding your equity position by paying down debt. And the lower the debt service coverage ratio, the more aggressive. And so when you're looking at a loan, you need to look at all those metrics to kind of get a good idea of how conservative or aggressive. And this is actually one of the important things that we discussed during our conversation with Jason, which is that just because one of them may seem aggressive, there may be the other two may be in such a way that will kind of make the entire loan appear more conservative. So for example, I used to really feel like anything above 2 years really of interest only was being kind of aggressive, and the sponsors were most likely trying to pad the overall cash flow profile of the opportunity, because the longer you are not paying back the loan, the smaller the payments are. So therefore, the higher the cash flow is going to be to investors. But if you're looking at, let's say, a 60 or 55% loan to value with a 5-year interest only period and a debt service coverage ratio of 1.7 or something, which is a reasonable if you're applying super conservative leverage, that would be overall, I would think that would be a very conservative loan. But earlier in my career, I may have written off that deal by just looking at the 5-year interest only period, which would kind of be a mistake. And obviously that was a little bit of a tangent, but just to get everyone on the same page, I think it's kind of important to kind of sum up real quick.
Yeah, so you hit the nail on the head there, Hunter. In fact, part of what we've done to de-lever risk in our portfolio is take on a little bit more interest only for some deals by significantly dropping the LTV. So instead of doing a deal at 75%, no interest only, and having to have a large value add component to it, you buy a deal that was relatively stabilized, that you want to put some value add dollars through equity in as opposed to through debt. You're looking at a fully amortized DSCR of, call it 1.5x. It's very easy to augment your yields a little bit by adding some, 5 years of IO, taking that 6% cash on cash to 9 to 10% cash on cash for that time period, because you have a substantial, substantial cushion in both the LTV and the DSCR. So at that level, there's no problem in taking on that DSCR. It's when you have the 85% levered deals that on a fully amortized basis are 1.0 or 1.1 DSCR on pro forma, and you overlay that with interest only, you could be setting yourself up for a lot of trouble in the event you don't see the type of growth you do and you click off the IO, move into an amortizing loan, you can no longer cover the debt service.
Right. Yeah, that's awesome. Okay, cool. I know that there's a lot of podcasts out there. Not that many will get into that level of detail on debt alone, so I do appreciate it. So you obviously have a really good idea of where we are in this market, the cycle, what's taking place in the market. What are some of the ways that you monitor these metrics in terms of what's available out there?
It's as much as we live in a technology world, is real estate is still fundamental. It's a people's game, and we have armies of brokers out there, both helping us on how the market is valuing assets, what's happening in the debt markets, what's happening in the capital markets, in everything under that same umbrella. It's important. I want to clarify that when we say brokers help us to value deals, that's simply what things are trading at. We internally value our own assets. In fact, the reason we can't buy assets right now is because we're much more conservative than the majority of investors out there. So we're getting blown out on deals when we're offering. A lot of deals we don't even offer on anymore because we know we're not even close. But it's very important to keep an eye on, or keep our finger on the pulse of the market, knowing exactly where things are trading so we can understand if at any point there is an opportunity to step back in.
Yeah, I appreciate the explanation, which is interesting because when Jason was on the program, he said as far as underwriting, he basically just inputs whatever he gets from the broker and just sees if it'll go by you. Just kidding. That's just been your standard.
We do have an interesting investment committee process, which is, Jason is what we always like to say. He's the endless optimist, and I call myself a pragmatist. I think he'd probably argue that I'm more of a pessimist, but I'm going to call myself a pragmatist because that sounds a lot better. And so when we go and evaluate a deal together, we usually get to exactly where we need to go. And it's always an interesting experience. I'm sure you guys would love to be flies on the walls in that. And there's typically more shouting than not. but it all works, it all works out well.
That's pretty funny. If Jason is the optimist of the group, that is some really conservative conversations you guys are having. So that's good to hear as well.
Oh no,
So
I have beaten him down over the past 4 years. You wouldn't. I'm railroading him to coming more to more to my side. Basically pulling him into the dark side as hard and as fast as I can.
perfect. So what percentage of your properties are currently financed by government debt, or is that the major strategy at this point? You mentioned agency debt recently. Is that the entirety of what you're pursuing right now, even though you're not exactly buying properties, but is that the majority of your focus in terms of debt?
It is agency debt is the easiest debt available right now, and frankly, the most attractive debt under the multifamily spectrum for the vast majority of deal structures. And utilization of debt and exactly what type of form of debt you use is asset dependent, depending what you're doing. A long-term, stabilized, moderately leveraged deal, the agencies are gonna beat everyone 100% of the time on pricing, on terms, on leverage. They're built for that. CMBS on the multifamily side is relatively uncompetitive. There's just not the third-party end user investor appetite for those CDOs anymore. When you go very low leverage, 50% and below, life goes become extremely attractive. We typically don't go that low, just because we like 55, 65 to 70% leverage. So life goes tend not to work for us. And then we have the balance sheet lenders for some of our bridge stuff, which would be value add, which are for all intents and purposes bridge to an agency execution. And then we have our construction debt, which is always bank debt. But the majority of our stabilized holdings are all agency, and that's just simply a function of their debt terms are better than everyone else right now.
Do you see us being in a similar position in the residential debt market or the residential cycle as we are in the commercial market?
Oh man, that's an interesting question. That's a really difficult one to answer. Typically, those shouldn't be as interconnected as they have been in the last in the cycles. Last cycle, commercial real estate and SFR, single family real estate, were inextricably tied together, and that was more of a function of the easy lending environment. We had turned single family residence into an investment class as opposed to a call it mortgage class or cost of living class, because CDOs had become so prevalent. They were incentivizing banks to just put any kind of paper out to any kind of borrower attached to any kind of SFR collateral. It's the Warren Buffett quote: "The second the shoeshine guy is giving you advice on stocks, it's the time to get out." In this market, you had middle wage, hourly wage earners building $1 million portfolios of single family residence to lease or to rent or to flip.
Right.
And that simply wasn't sustainable. So the commercial real estate and the SFR in the last cycle tended to trail together because debt financing was relatively similar for both those classes. Here, where we are, 2018, I would like to think we've been a little bit more conservative in how we've dealt with our SFR debt. We haven't really clicked up above the 80% LTVs. IO is back. It's been back for about 3 years, but we haven't seen the same level of lending on the spec homes, the investment homes. Those types of loans are still relatively hard to get and not entirely attractive for people that don't have a large swath of equity. So we're in the lending space and SFR as well, and typically you're maxed out at 60% LTV. If you want to go above 60%, your interest rate start creeping into the 10% range, which can become unsustainable. But even so, you're still talking about 30 to 40% down payments for spec homes compared to the 0% down payment spec homes we saw in the last cycle. So I would think in this cycle, the investment class real estate, which we would call commercial real estate, we've seen a pretty strong run up there because we've seen a very attractive financing terms. The SFR, we've seen those same attractive terms for people that are for end users. People are actually living in these homes. I don't think we've seen the same in the spec homes. So while we've seen a strong run up, we probably haven't seen anything remotely close to what we saw in the last cycle. So I think SFR in this cycle is safer or not as at risk to see such a strong pullback as we saw in the last cycle, whereas investment class real estate, we will see at some point, I don't know when that point will be, I wish I did, a fairly substantial pullback once we see interest rates start to normalize, a reversion to the mean, which is 6.5% or so, and moderate leverage coming back once fear re-enters the market or re-enters the banking sector.
Okay, so you anticipate the interest rates increasing as being the driving factor for a significant correction. And when you say significant, can you give us a ballpark of where you anticipate things normalizing? And I know it's speculative, but I'm interested in your perspective.
I think a 15 to 20% pullback is reasonable. Again, it's depending on how much fear enters the market, how much fear enters the capital markets, I should say. We're never going to see real, true liquidity crunches in the multifamily space. We see that more in the commercial, the office, the hotels, once some of the big boy investors stop allocating, predominantly the endowments and pension funds. But on the multifamily side, there's so many multifamily investors. There's from the mom and pops to the A+ institutions, that multifamily tends not to be as volatile, simply because there's a little bit more liquidity in the market there. That's my opinion coming from the multifamily sector. I'm sure an office guy might tell you the exact opposite, because I think we all like to think our industries are a little bit more recession resilient than others, but
totally.
That's
a
what
really
I
good
see.
point.
That is my opinion.
Yeah, and it's interesting because I focus predominantly on mobile home parks and self-storage, and I think that that's one legitimate concern, is despite the fact that these asset classes historically have been by far the best in terms of paying their debt. Like mobile home parks, most people think mobile home parks are just like, the credit collection is ridiculous and really challenging. It's the least in commercial real estate, if not second to self-storage. The problem is, because they're more niche real estate transactions, generally speaking, exactly your point, there's less liquidity in the market. So when things tighten up, tertiary or a niche real estate investments tend to struggle more. So it makes a lot of sense. I don't have a lot of exposure to multifamily, but generally speaking, I mean, what you're saying makes sense despite the track record of the asset class comparatively. It's something that everyone needs to be cautious of because of the fact that this whole conversation has really, been focused on the debt portion of the entire investment. How do you anticipate the repeal of Dodd-Frank affecting the real estate market, if at all?
I really don't see a real big impact associated with Dodd-Frank affecting the commercial or investment grade real estate market. As far as, Dodd-Frank was an interesting one. Dodd-Frank was introduced by the Democrats as a mechanism to protect the individuals, Main Street, from the banks. Banks being the banks, one thing the government always needs to realize is private business is always going to be smarter than the public sector. Is once we realize that, I think we'll be a lot healthier. And the private sector twisted Dodd-Frank to provide protections to the banks, aside from Main Street. This is most prevalent in if you've ever read an ISDA document or had bought any derivative, a swap, a cap, anything of that nature. Those documents, the documents that were generated from Dodd-Frank, that were supposed to protect the borrower, add all the protections back to the lender. It's almost hilarious. So from the investment grade, the commercial side, I don't really see any real impact. The banks might loosen up a little bit, but realistically, Dodd-Frank helped them on the commercial side more than it hurt them. On the single-family resident side, I think we will start to see some benefit there, primarily because the underwriting standards will go down, will contract a little bit, and more importantly, the paperwork will contract a little bit. If anyone's gotten a mortgage for themselves over the past 5 years, they've seen those hundreds of pages of documents that they need to initial that are Dodd-Frank requirements and disclosures, and the income requirements, the liquidity requirements, all that stuff. Those will start to loosen up if we see Dodd-Frank get gutted. So it may have some positive impact to single family residents. I don't really see any true impact on the commercial side of the business.
Are there any government programs that you've been keeping an eye on that investors should be knowledgeable about as it pertains to real estate investing?
Not really. HUD is HUD. As far as the tax reform, they were thinking about going after some of the tax credits which are utilized to build affordable properties, but those are such a negligible or such a small part of the market that you couldn't really see any true impact there. So as far as government programs, I don't see anything on the horizon to keep an eye on, or that could have any substantial impact to the market, with the caveat being that, especially in a Republican administration, I don't think they would do anything. But in the event the government starts to overreach, tries to start putting protections or belts and suspenders on any industry, you will see a substantial contraction there. And that I do not see happening, whether it be this administration, whether it be a following Democratic administration. I don't see anyone coming after real estate in that manner.
Okay. In terms of construction, obviously this is a huge part of kind of the last stage of the cycle. All the construction happens, all the square footage comes online. It's very challenging to fill up, and this is kind of what ends things typically. People see vacancy rates shooting up, banks stop lending. That's pretty much the end of the show. So are you currently seeing construction taking place at a significant rate, and where are you seeing the risk in terms of that square footage coming online most?
Yeah, absolutely. Is construction is at an all-time pace, almost back to where we were in 2004, 2005. This cycle, I think we've been a little bit more conservative in how we've built. The biggest problem we had with the last cycle is everyone built out. Is go find the cheap land, build anything with the idea that they will come. This cycle, we've tried to stay a little bit more towards the core, which helps for occupancies, and with rental rates rising, you've been protected from any kind of decline associated with absorption. But realistically, we are going to see some pain again. When you have 20,000 units coming online in greater Dallas, that will have an impact on occupancies, which will eventually put downward pressure on rents. When you see the same amount of units coming online in the greater San Francisco area, that should have some impact, although San Francisco looks like it may be in a position to absorb all this given the job growth out there. So with all the construction, at some point you will start to see a lack of positive absorption. In fact, that should probably turn negative. In fact, we've already seen that in certain markets. Dallas certainly being one of them, Northern California being another. Dallas, we've had a pullback of about 200 basis points from peak occupancy. Northern California, about 150 basis points pullback from peak occupancy. Rents are still at all-time highs because we haven't worked our way all the way through the deliveries yet. Right now, as far as forward-looking pipeline, people are pulling the reins back a little bit. We're not seeing as many permits pulled. We're not seeing as many shovels in the ground starting from 2Q17 forward, but we're still working through our construction pipeline that was started in 2016 and late 2015, 2016, and early 2017, which will carry us through at least the next 2.5 years.
Okay, and of those markets, obviously you're very skeptical of the national trends that are taking place, but are there any markets in particular that you think are incredibly overheated? I mean, you just mentioned two that are experiencing some negative rent growth or negative occupancy growth, but are there any markets where you're just really, really skeptical, really think that they're just complete in bubble territory?
Absolutely. It's called the United States.
Okay.
That is the market I see as being substantially overheated. The thing we have to keep in mind is we are at the perfect storm of unsustainability right now. We are at all-time historic lows of interest rates. We're just off that. All-time historic highs of occupancies. All-time historic highs of rental rates. All three of those things combined create a huge push in valuations. You see one of those turn negative, you're going to see a substantial decline in valuations. You see two of those turn negative at the same time, you're going to see an almost catastrophic decline in valuations. And I truly believe that over the short term, we're going to see all three of those start moving in the negative direction, which should put us back into correction mode. But to be a little bit more on point to your question as far as where do I see overheated, I truly do believe the United States is overheated. The markets that I see at the most risk are the markets we wouldn't have gone into in general, which are the ones we identify as the hyper-cyclical markets, the ones that have the highest highs that turn into the lowest lows, the Atlantas, the Phoenixes, the Southern Floridas of the world, the ones that people have short-term memories. They're very strong markets. They have good fundamentals in the best of times and horrendous fundamentals in the worst of times. So you can see valuations paying anywhere from 40 to 50% differential in those markets. And while there's a lot of money to be made there, there's also a lot of money to be lost. Post Investment Group being a mature business with a stellar reputation in the industry, we're not interested in going on and taking that added risk.
Sure, that makes sense. Let me ask you just one final closing question because I think it's by the nature of the conversation, I think it's important. Is there anything that you could see? Let's say you wake up and you get an email from Jason that says, this is an incredible opportunity. What would be in the contents of that email that would make you really excited to invest, on a like at right now?
Broken deals. So where we've made our money, typically through all cycles, through every inflection point of the cycle, is being able to do the most difficult, the most complex deals, and be able to do them relatively quickly, building equity, building capital structures that, as I mentioned earlier, extract maximum yield but significantly protect our downside. So if I get an email in the morning that says fractured development deal needs recapitalization, that's something where Post Investment Group has the necessary experience and skill sets to go and evaluate the real estate, the construction, the partnership, and and what it takes to complete it in a relatively short period of time, step up with large swaths of capital in relatively short periods of time, which eliminate a lot of the prospective buyer pools, which directly translate to more attractive pricing.
Right.
So those type of deals, broken, fractured partnerships, things like that, deals that are, again, complex, deals that would typically blow out the mom and pops from being able to participate, and deals that may be either too risky or are simply not big enough for the large institutions. That is where we play very well in difficult markets like this.
Awesome. Well, I really can't thank you enough. I really appreciate this, Jack. This is going to be one of those ones I listen to over and over again. So thanks again for coming on.
It's going to be one you listen to over and over again to put yourself to bed at night. I know that. There's nothing fun about talking about the debt markets and how boring it is to invest in real estate right now, right?
Well, I think it's interesting. I mean, we're going to have a variety of opinions, obviously, on the program at all times, but it's good to hear that there's a company that makes money based on investing capital and returning investor capital, et cetera, and it's the reputation what really matters. It takes time to make money in the business, and getting a couple of deals closed at the wrong time can really change your significant outcome. Real estate is a really good way to get wealthy over the long term, and it's not a get rich quick scheme. It's the furthest thing from it. So, I appreciate your perspective on it. And again, thanks again for coming on. All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.